Hello everyone and welcome to Moementum channel. My name is Mo, and in this video I'll be sharing with you our Smith Manuver portfolio that we have here in Canada. I'll also be sharing some updates on how our overall stock market portfolio is doing. Our dividends have grown over the past week and where we are headed with this portfolio. The content for this video is mainly inspired by one of the questions that we received on our channel from one of our viewers. Nick Leong posted in one of our past videos asking us to provide more details of our Smith Manueuvre portfolio, where it is at, and whether we are still pursuing it. The answer to that question is absolutely. We are pursuing our Smith Manueuvre portfolio, and this video is just for that. Let's get into it. Now, for those of you who might not be familiar, the Smith Manueuvre is a technique whereby homeowners in Canada who have their primary residence with at least 20% down paid on their home, tap into the equity of their home, be able to borrow that equity through a readvanceable mortgage as a home equity line of credit attached to their home, and then use that to invest. Now, by doing so and by borrowing that money from the attached home equity line of credit to invest, that portion of the borrowing, their interest is actually tax deductible. Here in Canada, typically, if you own your own home and if you're residing in your home, the interest that you pay on your mortgage is not tax deductible. I believe that's not the case in the US, but at least this is a legal technique that allows you to make that borrowing into a tax deductible portion on their mortgage. So very smart way to pay down your mortgage and pay off your mortgage faster, and instead borrow the same amount in a tax deductible manner. Now, we pursued this approach about a year ago. I believe we opened up our account through Scotia Bank STEP mortgage program around December of 2021. And now fast forward, it's been a year. It would be a good opportunity for us to go into it, how we've approached this account and all the progress that we've made through this account. As I alluded to it, we decided that we want to go with this STEP program through Scotiabank. We did some research. In fact, we went with a mortgage broker who helped us understand what our options are. At the time, we had options such as Manulife One. RBC also had another option that is geared towards Smith Manuver, but all in all, the Scotiabank was a better option for us. A few key reasons that really stood out for us. One was really around the rate that we were getting at the time. We landed on the Prime +1 for the home equity portion of our Smith Manuver account through the Scotiabank STEP program. So any borrowing that we are getting through accessing our equity, it's borrowed at Prime +1. Now that we've borrowed a little bit more into our account, we are getting closer to that $30,000 mark. There is an option for us to renegotiate that rate with our bank and possibly bring it down to Prime Plus 3/4. So that's something that we are interested in. We are pursuing that with our bank as soon as we hit that 30,000 kind of limit on our home equity line associated with our STEP program. Something to consider. The other reason that we wanted to go with STEP was the fact that they had the option of paying down your mortgage faster through 20%, meaning to say that you are allowed to pay down throughout the year up to 20% of your mortgage down without any penalty. That was another key reason for us to consider it. Some other banks have similar programs, but not as generous as the 20%. That was one other consideration for us. They do have other typical options as well. Let's say you can increase your payments as well by 20% on top of the total 20% lump sum payment. That's another side benefit. They also have an option of if you have paid down your mortgage, let's say sooner, if let's say you miss a payment, for instance, then you're not going to be penalized at one time. Look at the specific terms and conditions of your mortgage, but all in all, that was a consideration for us to go ahead with the Scotiabank STEP program. When we started to switch our mortgage from MCAP to a readvanceable mortgage through the Scotiabank STEP program, we decided as we borrow our funds through this home equity line of credit, we wanted to use that to buy more of a ETFs, exchange traded funds, because we didn't want to really get into the hassle of picking any stocks, and rather we wanted to maximize our performance by investing in ETFs that give you less amount of dividend and more so allows us to get capital gain. Now, on paper, this sounds like a perfect kind of combination and something that we were really aiming for. Now, in reality, last year has not been the greatest year in the stock market. 2022 has been somewhat of a disappointing year for many investors, and it's no exception for us either. In fact, our investments right now through the Smith Maneuvre is down by about 5 to 6%, which kind of sucks, knowing that some of the funds that we borrowed to put more money into this account is actually currently borrowed at close to that 7 to 8% mark. Looking at the last rate for Scotiabank prime rate, it is currently sitting at 6.45%. So our borrowing rate is at prime plus 1. So in other words, we are borrowing at 7.45% interest rate. Kind of sucks, but the positive to it is that any borrowing and any interest we pay is subject to tax deductibility at the end of the year. So once we file our taxes, we are expecting to get some refund through that tax deductibility of our account. Now, with that out of the way, initially we decided we want to invest into two sets of funds. One was the VEQT or Vanguard All Equity All into One Portfolio ETF. It's a wonderful exchange traded fund that really takes away the guess game out of your investments. It invests you diversified to different geographical distributions. You are invested in Canada, in the US, and internationally, but also distributed more so across different stock market sectors. I believe you're getting exposure to thousands of stocks through VEQT, and that's why we picked that. In the beginning, we decided, hey, we want to add a little bit more of that monthly dividend to it too. So that's why we bought XDIV. At the time, we had it for several months, but we decided, it's just going to complicate our accounts, knowing that when you get paid in terms of dividend, if that dividend has some sort of a return on capital, it might complicate your taxation. So that's why we ended up selling the XDIV pretty much at slight gains, pretty much at almost like a flat level, not really at the break-even point, and instead use that to buy more shares of VEQT. In a moment, I will be sharing with you our total amounts invested and the total number of shares that we have. But suffice to say, VEQT is our ultimate point as we are pursuing the Smith Manoeuvre Portfolio. For this type of investments here in Canada, we ended up opening a dedicated non-registered account to Questrade. Two reasons we selected Questrade. One was the fact that unfortunately we couldn't go with Wealthsimple Trade. Although Wealthsimple Trade would have been my preferred choice, we already had a personal account, and currently Wealthsimple Trade only allows you to have one non-registered account. And as you may know, with Smith Maneuvre, you have to have your investment in a non-registered vehicle and account because your interest is tax deductible. So you cannot open a TFSA or RSP for that. So you have to end up in a non-registered account. Hence, with Wealthsimple Trade not being an option, we ended up going with Questrade. The other reason that we ended up with Questrade is the fact that with Questrade, as you buy ETFs, exchange traded funds such as VEQT, you don't pay a fee if you buy them one at a time, even though you decide to buy them at larger quantities. Let's say if you buy 100 or so, the fee that you pay is very minimal, very, very minimal compared to when you buy stocks. Those all led to us going with Questrade and ultimately deciding to go with VEQT. With VEQT, it only pays its dividends distributions once a year in January, which again makes it easier for us as an investor to try to focus more on capital gain and have the slightest amount of dividend, because we want to use this more so as an appreciation kind of strategy. Their dividend yield hovers around that 1 to 1.5%. We are anticipating, now that we have a lot more shares of VEQT, to have some nice juicy dividends to get. But our approach, of course, would be not to use them and really use the funds to repurpose and reinvest it rather than kind of withdrawing it from our account. Really, the approach that we are taking with our VEQT account. Let's dive into our account and see where it is at, what holdings the VEQT that we have, where it is at, and how many shares we have. All right, as you can see here on our screen, the total amount of our Smith Manoeuvre portfolio currently sitting at $86,761. We are fully invested in Vanguard Investment All Equity Portfolio. It's the Vanguard All Equity ETF with ticker symbol VEQT, available in Canadian dollars. We have a total of 2,576 shares of VEQT with an average purchase price of $35.89. Given the last trading price of $33.67 for VEQT, our investments are down by close to 6.2%, or down about $5,740. Our approach with this portfolio is, as we pay down our mortgage every month. We borrow those payments, our equity, and use that to invest and buy more shares of VEQT. On top of that, throughout the month, we try to accelerate our mortgage prepayments. We do some prepayments and pay down our mortgage faster. And after about 1 or 2 investment statement cycle, those funds then become available to us through Scotiabank STEP program, and we can use that to, again, borrow more quickly through our HELOC program. And that's how we've been able to kind of invest more rapidly. Looking at the return and overall investments size of this portfolio since the inception, you see since about December of 2021, when we initially started this account and started funding it, we were sitting at around $68,379, and right now we are sitting closer to that $87,000. We have put in and deposited close to $92,000, but given that this fund is down for the year and for this 1 year that you're noticing, we are showing that negative overall return that you saw just earlier there. Now, with that out of the way, we want to also take a quick look at our overall portfolio, our dividend and growth portfolio that my wife and I have built. This includes our Smith Manueuvre portfolio, but also other dividend and growth kind of exchange traded funds. In total, our biggest holding currently is VDY with 3,900, close to 3,900 shares between my wife and I, or a market value of $165,725. VDY across our accounts between my wife and I is up by 1.3%. It does pay a monthly dividend. I'll be showing you as well shortly the amount of dividend that I collected for my own account. I don't have access to my wife's, so I won't be able to show you those ones, but it was really nice to collect the juicy close to 400 to 500 dividend income just this few days ago. Our second larger holding is VEQT that we talked about earlier, our Smith Manoeuvre portfolio, so I won't be diving into it. The third large holdings that we have is VFV. This is Vanguard S&P 500 Index ETF, giving us 100% exposure to the 500 largest companies in the US. We have a total of 895 shares, or about 22% of our portfolio. It is up by 3.9%. VFV does pay its dividends on a quarterly basis in the months of January, April, July, and October. Our next big holding, the top 4th spot, is XEF, or the iShares Core MSCI Europe and Far East Index ETF with ticker symbol XEF. We have 593 shares of it, or about 5% of our portfolio. Gives us that more of an international exposure. This one pays its dividend distributions on a biannual basis in the months of January and June, and currently it's up by 4.4%. Next, we have shares of V with ticker symbol VEE, or overall 571 shares. This is Vanguard FTSE Emerging Markets All Cap Index ETF, which is up by 3.7% for us. Lastly, we have 165 shares of XIC, or with a market value of close to $5,200. It currently is about 1% of our portfolio, but we want to make it into a larger position and bring it up to about 10% of our portfolio. Currently, it is down by 1.9%. We do have 15 shares of Bank of Nova Scotia since months ago, and our the plan is, as shared in the past few weeks video, is that as soon as it hits that kind of break-even point or slight positive, we're going to sell our shares of Bank of Nova Scotia and repurpose and use those funds to buy more shares of other ETFs that we have here. We want to kind of keep this portfolio as clean as possible, mainly investing passively through high-quality exchange-traded funds. On top of that, Bank of Nova Scotia is one of the holdings that we have through VDY as well as XIC, so there's no point for us maintaining those separately. Our portfolio currently is up by $833 in unrealized profit, or just about 0.2%. We have a total dividend annual amount estimated to be at $10,685. If we divide it equally, that averages about $890, just shy of that $900 mark. We're getting there slowly but surely. If we divided the whole expected dividend income into the number of days in a year, that averages about $29 a day. Not too bad at all. Currently, our investments in these ETFs and the Bank of Nova Scotia that we talked about gives us 52% exposure to Canadian businesses, 32% exposure to US businesses, and 16% to international. But our targets are slightly different. We want to get only 40% exposure to Canada, 30% to US, and 30% to international, which means over the next several months, we'll be putting more emphasis into buying more rapidly ETFs that we currently have that gives us more exposure to the international markets. Now, I know I mentioned to you that I will be sharing with you the latest dividend income that I had in my own portfolio. You notice VDY really on top of the list. A few days ago, we earned a nice close to that $500 total amount of dividends from VDY, collected through 3 different accounts that we have. For myself, it's the unregistered personal account, tax-free savings account, and the registered retirement savings plan account, based on the number of shares that I have in each one of them. In December, I also earned a few other, dividends from some of the other positions that I used to have. I used to have shares of Royal Bank, but I sold them off. So these are some of the dividends that I earned at the end of the November were still based on the shares that I used to hold at the time that I was eligible to collect those dividends. These are only for my accounts and not really showing my wife's. I don't have access to her account. Just wanted to show you a little bit of a glimpse of how these dividends are added to our accounts and how we use them to repurpose and actually buy more shares of these high quality dividend income ETFs for us. Thank you so much everyone for watching this video until the end. I hope you found it beneficial and you gained something of value from it. If you did, don't forget to smash that like button and subscribe to our channel. Here on Moementum Finance, we post every week videos about investing, including investing in dividend stocks, growth stocks, penny stocks. We also talk about investing in crypto and real estate, as well as discussing how you can pursue ways to reach financial freedom and financial independence. Thank you, and I hope to see you all next time.